saw a hiccup the other day. Naturally, the Fed decided that, hey, we're going to do the thing that we said we were going to do, but now we're going to cut back a little bit. We think we might only need 2 cuts going into 2025, not the 4 we were planning. And of course, the market didn't like that too much as well. Well, that's why we offer the Blueprint, the full course at Radioactive Trading, the married put approach for controlled risk and muting volatility in the market. And of course, right now is our special end of year bonus. You pick up the Blueprint before midnight on December 31st. You're going to lock in these 8 special bonuses. The Fusion subscription at Radioactive Trading, where you can follow along Ernie and my married put trades, how we apply the income methods, continued lessons, members-only content, webinars, and more. The Fusion subscription just focuses on the married put approach, but if you purchase the Blueprint, you'll get an electronic coupon to get your first 2 months of Fusion for only $10. You'll get the free Foundations of Radioactive Trading video. That's an $89 value. And you'll also get an additional bonus video, the 4 Insider Secrets of Trading, our 4 most requested replay webinars for the Radioactive Trading Married Put technique. You'll have immediate access to the Quick Start Guide. You'll also have immediate access to the Blueprint, as it's all electronic right now. You'll also get a free month of power options included in that. It's actually a $120 value because you'll be bumped up to the real time, I believe. Yes, you will be bumped up to the real time. My apologies. As I mentioned, it's instant access. It's all electronic. It's supported on our educational portal, learn.powerop.com. Of course, and you'll get any coaching and email and phone support for free to discuss the management techniques, income methods, and much more as you go through the Blueprint. And of course, you'll have instant access to the members-only content as a Blueprint owner as well. In addition to that, it's a 30-day money-back guarantee. If you're not satisfied with the Blueprint, with the techniques that are shown there, that you don't think it's going to fit in your account, no problem. Just let us know in 30 days. We'll refund the purchase price. Take care of everything that way. So no worries there at all. It's completely risk-free in that sense, starting off 2025 risk-free if you pick up the Blueprint before midnight on December 31st. Okay, we'll talk about that a little bit later on also. All right, well, all that being said, let's navigate over to our Power Options suite of tools. Well, the portfolio tools on Power Options. These are some of the positions that we put in to track looking at comparisons earlier this week. As you can see here, we're looking at 2 married puts versus 2 covered call positions and the comparison between the two with MicroStrategy down 10.9% in a high premium. You'd only be down about 6.1% right now at a liquidation value for today's expiration with that decline. And Astina, which is up about 13%, well, you make a 4% return with the capped gain be assigned on the position. Now, on the other end, of course, what we're looking at here is a comparison of 2 covered call positions. This is for a presentation that's was done based on a YouTube question that came in. But in any case, 2 covered calls on the same stock opened at the same day at the same price, $44.50 and $44.50. And MSTR MicroStrategy opened at 408.76, now currently at 364.20. So a move of about 13%, a move down of about 10, 11%. And what we see here is that with the covered call, you hedge some of that loss. You only lost 6% of the 10.9, let's call it 11% decline. But then you cap the upside, so you only make 4.1%. Meanwhile, with the married put approach, without any income methods applied, the same positions as we would have opened the strategy as Azenta and MicroStrategy were up 7.4% on the married put. That's what we expect, even with the put in place without doing any income methods. We're expecting to make about 55-60% of the underlying gain in the stock price. And then, of course, we're going to do the adjustments to lower that initial at risk. You see the expiration all the way out to July, of course, is still a risk of 4.8%. But we're going to be able to probably bulletproof this trade today. Let me take a look. 50, 50. No, we're not going to bulletproof this trade today. We're going to show an adjustment on this position and possibly also an adjustment on MicroStrategy, which is down about 11%. But because of the married put structure, we're only down 5.5%, about half of the loss on the stock position due to the guaranteed insurance that's all the way out to June, still 182 days out in time. So a tale of 2 stocks. We've got Azenta and MicroStrategy both opened on the 16th of December with the same prices. One strategy we entered as a married put, we're up 7.4% unrealized gain on the first position, and we're only down 5.5%, or about half of what the stock dropped on the other. Meanwhile, in a covered call strategy, we did make a 4.4% return. Let's call it that because that's an assignment without the little time value still holding in there. But we lost 6.1% even with the covered call hedge. So we're still down about 1.7%, whereas right now we're up about 1.9% on the married put structure with these two different stocks with a similar movement over that 4-day period. And that's the idea of the married put, of course, is flipping the covered call on its side. So instead of a risk graph where you've capped the upside and left the downside open as you would in a covered call, we've limited the risk to single digits out 5, 6, 7 months out in time and left the upside open. Of course, now with the stock at 50.43 from our initial price of 44.50, and we did buy the July 50 put. We could do a variety of different adjustments on this trade, following the rules in the blueprint. The first one of my favorites, would probably be income method number 4. See, this put is not just guaranteed insurance to give me a floor. It's actually a second working asset. Now, when the stock was at 44.50, we paid $8.50 for this put. That did increase our cost basis up to $53,000 for 100 shares of the, oh, sorry, I did 1,000 shares in this to make it even. It was equal in the portfolio. 1,000 shares of the stock and 10 puts, and 1,000 shares of the stock and selling 10 calls against it. In any case, the stock was at 44.50. The July 50 strike put, $5.50 in the money, only cost $850, or $8,500 roughly for the 10 contracts. $850 if we did one contract, of course. The remaining $3 of that premium that's not intrinsic is the time value. That's the risk. The time value for 210 days out, or 214 days out in time, was the worst case scenario for this position. $3 if we did it, just with the basic math of 44.50, paying the $850 for the stock, having $53 invested, and buying a 50 strike put, our maximum risk is $3 or 5.7% of what is invested. Now the stock is trading at 50.43, a little bit above our put strike price, but it's still a July put. So we haven't lost that much on the put option. We have lost, the put has declined. But if we take a look, now bid-ask spread is a bit wide. So I don't know if we'd get the midpoint. But let's just put this back in and say that we're going to sell to close our July 50 put now that the stock has moved up. And in midpoint, it's at $6.50. I think it's going to be closer to maybe $5.90 or $6. So let's just put that in at $6. What does that mean? It means we bought stock at $44.50. It's now trading at $50.43. Pretty much a 6% movement of the stock. We've only lost about $2.50, $2.60, $2.70 on the put. We're still in a positive delta position. That's why that upside is open in that case. So now we've sold to close the put, and we've cut our cost basis from that initial $5,300, and that's the worst case scenario. This the break even was $53, but that was a July expiration, not today. We're in a profit today. You saw that. We're in a gain of 7.4% in just 4 days with the movement of Azenta. But now, what do I want to do? So what happened here? Well, what happened is when we bought the put, the stock was trading at 44.50-ish, and we bought a 50 put that was in the money, above the current stock price. What we sort of did is take advantage of the at-the-money bell curve. And what the at-the-money bell curve shows is then we're buying options. We want to be buying here on the wings, either out of the money or either in the money. Now the stock has moved up. Our 50 strike put, remember when we bought it, only had $3 of time premium or extrinsic value. That $5.50 was intrinsic. The remaining $3 was a time value. Now that the stock is trading right at the put strike price, the extrinsic value actually increased. It swelled because of the at-the-money bell curve. When you look at any option chain for any expiration, the call and the put that are at the money will have the highest extrinsic value, the highest time value at any time. So what does that mean? That means the options that are in the money now or out of the money now have the lower time value, where our at the money 50 strike put has the highest time value for the July expiration. We're going to swap that. We're going to take advantage of it. We're going to sell to close this put for $6. I know the midpoint said it was a little bit higher, but we're going to use about $6. We could use maybe $5.90. We're going to keep it at $6. And at the same time, we're going to move up. We're going to swap up to the 55 put, which again has a wide midpoint. I'm not sure that we're going to get it, but let's just take a look at what that midpoint would be for 10 contracts. And that's going to be at 885. Okay, this is about right. This is about normally what I see when I use income method number 4 on my personal married put positions going forward. Now, what did I just do? We already took into account the price of these two. Our total cost in the position was $53 per share, or $53,000 for 1,000 shares and 10 contracts, $5,300 for 100 shares and one put contract with our married put approach. We're taking $6 off the table on that position for just the extrinsic value, the time value that remains, and are just out of the money July 50 put and still 210 days out in time. And we're adding $885 to our cost basis. We're increasing the cost basis by about $285 up to $55.85. Now, why would I do that? I increased my cost, the debit here of this move, by $285 to guarantee a 5-point higher payout. So essentially, I am locking in a profit of $215 on this position. And that's going to reduce our initial risk. Remember, we had about a 5.7% initial at risk on this married put trade. Now with the movement upwards, we're able to roll it. The maximum risk, and this is the worst case scenario, on July expiration, 210 days away, even if the stock collapsed to $10 per share, the most we could lose is 1.5%. 85 cents on the position, because now we're guaranteed to get $55 back. In a discussion 2 weeks ago, we showed a different example of this income method number 4, and one of the attendees asked the question, is like, why would you add a debit to the position, and increase your cost basis? Because the debit we pay with this income method, we are adding to the cost basis. He's completely correct. But the debit we're adding in this adjustment is always less than the higher guaranteed payout. Think about it this way. If I just liquidated this married put position and took the 7.4% profit today, which no one would fault me for that, 4 days into the trade, just get out with 7.4%, did better than that covered call on Azenta, which only made 4.4%, excuse me. Well, why would I take that profit? I could take that profit and then invest in something else or invest in 2 other positions. Why wouldn't I do that? Well, my answer is if I'm still bullish on this position, I still have the bullish outlook on the market. Not necessarily saying I do immediately in the next 20 to 40 days, but again, if that's my outlook, what did I just do? I just paid $2,800 to guarantee $5,000. I locked in that difference of $250, or $2,150. If I take the profits now and open a new position, can I get that guarantee anywhere else? No. I might be missing some opportunities, sure. I might pick a next big trade that goes up 13, 14%, sure. But this is a guarantee that I've paid $285 to guarantee 5 points back. Now, I'm in a position here with only an 850 risk on 1,000 shares and 10 contracts. 85 cents risk, 1.5% of what I have. Well, naturally what I can do here, again, maybe taking advantage of the ATM bell curve, maybe giving myself some more movement upwards. The ATM bell curve, why do I keep pointing this out? This is one of the 3 core principles discussed in the blueprint for radioactive trading and the married puts, but it's really for any strategy. Forcing an ideal size trade, the at-the-money bell curve, and of course, the radioactive decay line. Why am I buying a put 210 days out? Because you have a slower decay to begin with. And this would be, say 90 days out, and this would be 60, and you get down into 7 days out in time. This is where we want to be selling, where that rapid time decay occurs. We want to be buying out here, not only to give the market more time for the stock to move in our direction, but also initially to take advantage of that slower decay before it starts to really kick in on the time value, extrinsic value. And you see that. We've only lost 250 when the stock moved up, so we got the advantage of the at-the-money bell curve, and we haven't seen much time decay yet because we're still up here at 210. All right, so those are essentially the three core principles. Did I force an ideal size trade? Absolutely. My maximum risk, remember, is only 5.7% when I started the trade. That's the absolute worst case scenario on the position. But okay, we've picked the right stock. It's moved up as we expected. We use an income method right now to cut our risk down, by more than half. We had a 5.7% risk. We've got it down to 1.5%. And of course, we can reward ourselves. Now, Azenta only offers monthly options. That's fine. I do my research. Hey, do I have earnings coming up between now and expiration? Okay, maybe I do, maybe I don't. Let's say that we don't. And here we go. I just rolled up to the 55 put. 55 call, again, has a wide bid-ask spread for this particular position. But look at the bid at itself. 85 cents. What is that 85 cents? That's the remaining risk after I used the put option, a second working asset in my favor to manipulate the position, cut the risk down to 1.5%. Let's go ahead and sell that call. Let's just take a look at what the midpoint is for that position. It's going to be around $1.20. Let's just call it $1.20. Let's be nice to ourselves. And what do I have? I now have a position that is bulletproof. My maximum risk has dropped to guaranteed 35 cents, $350 for the 1,000 contracts, 0.6% return. That is the absolute worst case scenario on this position, even if the stock falls down to $20, $30, $35, $40 per share. A max profit, if the stock's trading at 55, in an additional 28 days, so 32 days at 12.3%. Below where the stock is because of the put decay, I'll admit that. But remember, when I started the position, the worst case scenario is only 5.7%. We saw the comparative example there when we were looking at MSTR, that's down 11%, and we're only losing about 4% on the position. So now I have a bulletproof position, potential to make double-digit returns in about 32 days on the trade. Not every married put gets bulletproof, but that's the income methods for the married put in action. The put is a second working asset. There is actually 4 income methods in the blueprint that are related to manipulating the put option, whether the stock stays the same, whether the stock moves up, whether the stock moves down, or if you're anticipating a movement up or down and you want to add extra protection. Those are income method number 4, income method number 3, income method number 9, and income method number 12 in that full course, the blueprint. And then the very simple one, income method number 1. And that's selling this 55 call here. And we got about $1.20 for it. That put us into bulletproof status. Still have a positive upside and another 10% before we hit that capped gain and start giving back, because it's like a calendar spread. We'd start giving back on that profit. What happened? Why are we seeing this? What happens when the stock goes up to 60, 65? Well, remember, my capped gain right now is at 55 because of the call I sold against it. Just like the covered call in the stock positions we saw in the comparison portfolio just a moment ago. But as the stock continues above this price, essentially my call delta is going to 1 as we're getting closer and closer to expiration. I'm not gaining any positive value on the stock, but at the same time, what is happening? My 55 put is losing more money as the stock goes up to 57, 58, 59. That's why you see the fall off in this scenario as we go up to the higher prices. Jen asks, what if there were earnings between now and expiration? Would you still sell the call against it to get to bulletproof status? Not necessarily. What I would prefer to do in this situation, I would still roll up the put in this case, Jen, and get into that near bulletproof status. I still might sell this January 55 call if Azenta did have earnings coming up on January 5th, January 7th, January 10th. Let's just take a look here. I'm going to use that more information button here. This is how we navigate into the further research on power options, whether you're in the search, you're looking at a specific option, or you're just here on this details page and we're looking at a specific search. Let's take a look. And 2.6. Okay, so the earnings are not coming out. But let's say that earnings, of course, Jen, were coming out. In the blueprint, other income methods such as income method number 5, income method number 6, and income method number 11 are different types of riskless spread trades. They're spread trades we can use in the married put structure that do not add any risk to the position and don't require any additional margin requirement into the trade. And what I might look for in this case, we've got ourselves into a bulletproof status by only 35 cents. Sake of argument, we just saw Zenta does not have earnings coming up until 2/6, but let's say they were coming up on January 5th, January 6th, somewhere in that time from January 7th, whatever, January 10th, I think I said. Now, I sold the call, which caps my upside. And this is out to January 17th, my apologies, January 17th, 28 days out. Now, if I'm concerned about the stock gapping up in price, what might I do now? Take advantage of another aspect. Instead of just doing income method number 1, selling the call against the position, it's not going to keep me in bulletproof status, but I'm going to go with this one at a midpoint of about 45 cents. What we're going to do is sell the 55 call, that we already did. And Jen, what I'm going to do is buy a higher strike call. I'm just going to use the midpoint there. It's going to give us 45 cents. Now, this removes me out of bulletproof status, but what did it do? It gives me this little nice bump in the position. So if the stock's moving up towards earnings, towards 55, and then earnings happen, it has a nice gap up to 65, 67, 68. Instead of the profit and loss chart we saw with just selling the call, where it petered out after 55, and we could manage it too. There's ways to discuss different ways to manage that sold call if the stock breaches that strike price. Of course, you could just roll up the call. You could take assignment and sell a put to get back into the position as well. That's all discussed in the blueprint. But what I've done here is pretty much gotten myself to bulletproof status. Only 10 cents. Maybe I try to finagle with a bid-ask spread when I entered this position for the 2 options, Jen. But this method, income method number 6, gives us a little heartbeat, gives us a little bump. And so what have I essentially done? I sold a 55 strike call, and I bought a higher strike 65. If you just entered that at your broker, what would you be in? We'd be in a bear call credit spread, where we'd want the stock to stay below 55, so both options expire worthless, and we keep the net credit between that $1.85 or so we got here. I'm sorry, yeah, that $1.47, $1.20 it was. I apologize, $1.20 that we got here, and we paid the 45 cents here. And you'd have to put up the 5 points of margin requirement to cover that difference in the spread. But inside the married put structure, that's not what it is. That's not what your broker sees. What does your broker see? Well, ignoring these 2 here that we rolled out, but we've got our 55 put against our stock. We've got a married put with a sold call against it and an extra long call. The 55 call obligation, even though I entered a bear call credit spread here, the 55 call strike obligation is covered by the stock ownership. I don't have to put up the margin requirement. My broker just sees this essentially as a covered call or a collar, where my obligation is covered by stock ownership with an extra long call to leave the upside open in case that earnings event gives us a large run. But right now, Jen being about 10% out of the money here, not having earnings between now and expiration, I wouldn't add that little flare, that income method number 6. I would do that, and I have done that around earnings. I'm just going to leave the position as is. We rolled up the put, used our second working asset. We paid $285 to guarantee a 5-point higher payout. We reduced the risk by $215 with that approach, locked it in, pocketed essentially, and then we rewarded ourselves by selling the call. No risk position, with still 210 days of guaranteed insurance going forward. And if this call expires worthless, well, I might just be able to sell a February 55 call, get another $1.20, and increase my bulletproof status up to 470, and increase the return potentially up to 14 or 15% if it's trading at around $55 come February expiration. Yes, naturally, I do these income methods and continue this trade because I'm still bullish on it long term, even though we know there's going to be some volatility going on in the next 20 to 40 days. But again, the whole aspect was we muted the volatility across the market, right? A tale of 2 stocks. The initial married put on Azenta we just looked at. invested $53,000 in this position, but we had a guaranteed exit of $50,000, and that's in the worst case scenario. That low risk of only 5.7%, and as the stock moved up 13.3%, we're still up 55-60% of that at 7.4% if we decided to liquidate the position without any income methods. But then we just showed we could do one income method to adjust the put, use that second working asset in our favor, that's income method number 4 in the blueprint, and the basic income method number 1, generate some premium. Now we're in a no risk position on this trade. Potential upside profit of 12.3%. The stock needs to move up another 8 or 10% for us to even be concerned about rolling that or adjusting that. And we still have 210 days of guaranteed insurance in the position. We're still following the 3 core principles. Forcing an ideal size trade, bulletproof, no chance to lose. Taking advantage of the at-the-money bell curve, yep. We did that with the put option. We've rolled our at-the-money put that had an increase in extrinsic value up to an in-the-money put. We just paid $285 to lock in 5 points. And then we rewarded ourselves with the call because we want the call to be equal to our at-the-put strike price. And now we're in a strong position where we can still do other adjustments in management as we go forward to January expiration. On the other end of it, of course, the MicroStrategy married put, opened at 408.67. We only did 100 shares here to keep the price even. We bought a $14.85 or $144 put. My apologies, but still about $55,000 invested. The stock plummeted 11%. We're only down 5.5%. Tale of 2 stocks. We're still in a positive unrealized gain with the married put structure. Same 2 stocks, same prices. $44.50 for 1,000 shares of Azenta, plus 10 call contracts at the 45 December 20th strike call for $1.40. Hey, we made the max 4.4% return. And buying MicroStrategy at 408.67, getting a good premium of $20.75, a potential return of 7% on this position. But the stock's down 11%. We're down $2,300 or 6.1%. Flip a coin, one stock's up 13%, one's down 11%. With the married put, you're still at a profit. With the covered call strategy, you cap the gains there to get that premium. And on your other position, it didn't work out as you wanted to. You're down, about $600, but you're in the negative. Same 2 stocks, same price. A tale of 2 stocks. Is it the approach? Am I saying that covered calls can't be profitable? No, I'm not saying that. Well, what I'm saying is when you look at the 2, covered call structure does what to you? It cuts your winners short and still allows your losers to run. The hedge you get on the covered call is only the premium that you receive. The married put approach, using the blueprint and the 13 different income methods, we're flipping that on its side to where we're capping our losers short, guaranteed, much better than a stop order or a trailing stop. It is a guaranteed that we're going to get that $50 back for Azenta. Now the $55 back with that income method number 4 adjustment we used, and we leave the upside open. Stacking the market odds in your favor. Cut your losers short and let your winners run, rather than the covered call or cash secured naked put that cuts your winners short and still allows your losers to run. You're still taking on 95, 96, 97% of the risk of owning the stock in those strategies.